What we're going to talk a bit about is where do you get alpha? Because I suppose here's the key question. I traditionally have always written about investment. If you talk about investment, you understand where you can get extra returns from. Yeah. So where do you get extra alpha from? Above market returns, above beta, is what we investment-oriented people would use. So you know where you go. You sometimes take extra risk. You do invest in different things, and it's fairly obvious, really, how you do stuff with equities. Same with bonds, actually. That's just same with bonds. You go up and down credit spectrums, that kind of stuff. In this space, it's really. That's the reason we ask the question. It's really quite difficult, though, isn't it? Because at the end of the day, one of the big things that's happened is that there's been a move to not cherry pick, for not let institutions cherry pick. Yeah, which I think on balance, most people would agree is a good idea, unless any of you disagree. I think on balance, it's saying that institutions shouldn't cherry pick. And because they can't cherry pick, so how are they going to get extra alpha? And surely the only way of doing it is to take extra risk, Simon.
Yeah, thank you very much.
That's a pleasure. I thought I'd open with you.
That's the hospital for us, isn't it? No, I mean, look, I disagree very strongly with that.
Good.
I think there are many different types of alpha you can generate as an asset manager. And when I look at them, I think there's a huge amount of alpha in this industry in the platform selection, the original due diligence that you do on platforms. So I'm sure most of you know P2PGI has today 18 platform partners, curating that 18, making sure you work with the highest quality, not just the highest quality, but also the platforms that through the cycle create a return for you that is that sort of weathers a cycle, and there's a huge amount of alpha therefore in the DD and bringing on the better platforms that you believe can drive high quality loans to you. And then there's the whole sort of debate of creating alpha through selecting grades on platforms down to selecting individual loans on platforms. And I also believe there's a great degree of alpha in leverage. And
I'm going to come back to that, yeah.
And although it sounds oxymoronic, it does sound oxymoronic, especially when you see investors, I strongly believe that you can reduce credit risk through leverage. And good leverage documents and good leverage terms are today pioneering and therefore create alpha over and above other strategies.
So you've nicely bookended a lot of things we're going to come up and talk about in this panel. But before I go talk to some of the platforms, Jean-Benoit, I mean, my question, I suppose, is with the platform due diligence process. We had a conference call before this event, and actually Jean-Benoit mentioned that as one of the key things you thought was really important. But surely you could just go and copy what he does. So basically you could just go, well, you know what, I agree with your platform due diligence point and your curation point. I'll basically just piggyback off what you do, and I'll maybe instead of doing 18, I'll do 13 of the right ones. So does that still stand true?
Yes, that's true. I can just copycat what Simon does, but in fact I will have some difficulty because I do not I do not know the portfolio of Simon. There is not a fact sheet saying, okay, he has invested 10% in Lending Club, X% in Funding Circle. So I have no idea, but I know that if Simon is managing, I don't know, 500 million or 870 million.
Only 370.
Yes, I know that he has to invest in the biggest platform because you cannot deploy 850 million quite easily in this asset class. So you have to work with the biggest one. So I think one of the alpha you can add is to work with smaller platforms.
Yes.
So a few years ago, 2 years ago, for instance, US consumer was really attractive. Now it's quite crowded. The interest rate have decreased a lot. And now we see new opportunities in Europe, for instance, in much smaller platform. And if you work with smaller platform, you have to do your diligence and to be sure that you're not going to lose your money.
So that's a good point, Simon, and I'll come to you guys. Basically, you're just too big.
I disagree with that as well. I think there are some amazing sort of, whether you call it alpha, but synergies of scale. And I touched on it earlier, but achieving attractive spreads in leverage is one of those. It's very difficult to attract cheap borrowing if you want to borrow £5 million. If you want to borrow £100 million from Deutsche Bank, it's a becomes a different game. So and also, scale gives you to a certain extent some negotiating muscle, and it also gives the platforms you work with some future visibility. They know that your size and you'll be here tomorrow and the day after, and that makes them, I hope, slightly more interested in talking to you than if you manage sort of a much smaller amount of money.
So scale can cut both ways. Let's kick off. Christian and then Madelyn, I'll take you just move along. Christian, what's your take on this? I mean, these guys are quite big, big fun players in this space. I mean, how do you find that they're producing alpha? What's from your side?
I think the institutions definitely can create alpha for their investors, and I think Simon's mentioned some of those ways with leverage and so forth. But I think probably the real way that alpha is produced is through deep relationships within the market. So I think I even remember talking to Simon. We were setting LendInvest up sort of 2-3 years ago, and I think Simon was very early to this. And I think there's some other players that have been investing in peer-to-peer and marketplace platforms in both the equity and the deals, or the loan deal flow for a long time. And so I think understandably those deep relationships provide access, and they're able to develop products with the platforms. And
what access do they actually provide? I mean, that's what I'm trying to get at. Well, why does the historic nature of that relationship? What does it actually mean?
Well, I think what it means, so practically from our perspective, it may not be daily, but certainly on a weekly basis, we'll get hedge fund XYZ wants to invest in our deal flow, which is great. But I think also with that, there is generally a fairly unrealistic expectation of return from sort of players that are coming a little bit late to the space. And so, we can meet with those players and we can try and sort of produce a product which is interesting for them to invest in, but it kind of doesn't work for us, where I think deep relationships and those that have been active in the market for a long time, they understand what we do, they understand the sort of asset class that we're originating, and I think they're more in tune with what we're looking for as well. So I think it's a more useful, productive relationship with those sorts of players.
The longevity in relationships is a real crucial feature. Yeah. Madelyn, your side from MarketInvoice, where do you think the fund managers could really add value, really add alpha?
Certainly the managers who are having the most, we have on our platform, even last year alone, quite a wide range of returns from the institutional investors. So our approach is that we really allow investors to pick their own strategy. So by giving them all of the information that we have and making that transparent to them and making sure there's sufficient diversification in each parts of the spectrum of risk, we really just allow them to make their own strategy, and they're executing quite different strategies on the platform. So I think for us, it's just giving them the opportunities, allowing them to do their own work. I mean, the investors who perform the best are the ones that take a really proactive approach, credit selection, and are quite demanding on the information that's provided because they're doing a lot of work on the back end.
Let's explore then the ones, you said there's a wide range of returns. Is there a wide range of returns because the ones that get the best returns are doing the best job, or is it the ones that are getting the best returns are taking the most risk? So talk me through why it is that some people are doing better from, getting better returns. Sorry, that's a loaded term, but getting better returns than others.
Yeah, I mean, I think certainly the investors who we have a broad range on the platform. Yeah. If you kind of default to the average, there's a lot of investors who are doing that, which is fine. It works especially for some of the smaller institutions or high net worths who are investing, who are maybe not taking an active approach. But the institutional investors, they'll either take a really high risk strategy, and that can pay off in either direction. I think the investors who have discipline, who approach us with more of a traditional asset management approach, and they look at their exposures, they look at sort of the expected loss, they do the work on the underwriting that we do. So the investors who really understand how our underwriting works.
So they actually come in and talk to your underwriters and sit down and understand how the underwriting process looks?
So they do, certainly the ones who perform the best, it's because they understand what our band 1 means versus our band 10. And encourage us to continually recalibrate our model, and they know exactly what they're getting, and then that feeds into their own strategy, their own portfolio allocation.
Do you find that if they come in, they look at your underwriting strategy, do you find that they come in with their own pre-existing models? And because you work in a relatively new asset class, in a sense, it's not been very investable, your asset class, until recently. Whereas actually, arguably, Christian, your category's been around a bit longer. You sort of know what elements, you know what property. But yours, it's difficult. Are they coming in with traditional corporate credit models and just saying, I'm going to tweak them, or are they coming up with whole new models that they've devised?
It's a range, and I think we try and accommodate a range. So you have investors, especially at the higher institutional, like larger institutions, more developed, they already have strategy around receivables.
Okay.
So they understand how to price the asset class. Other investors who approach us as just a peer-to-peer platform, they need to do the work to understand what makes receivables different from general SME loans. So they may be trying to fit our model in, but that's kind of where we come into play and explain how our model works.
On a quick thing, because both of you did before you even invested, because I think you're definitely invested in MarketInvoice.
We're not.
You're not? Oh, well, I thought you were.
No,
okay.
no, we're not.
Are you? Yeah. You are. Did you come in with an existing, receivables credit model? Before you even started looking at it, did you either of you have one, or have you had to build one?
No, we are definitely to build one. It's a new asset class. It's a new platform. If you compare, for instance, MarketInvoice with their competitors, it's totally different. The information is different. The auction is different. The process is different. Even sometimes the maturity and the credit risk. So you really have to work platform by platform. But after some times, when you've met like a 50 or 100 platforms, you start seeing, or you start knowing what you have to look at, and after you just, if you see that the platform is big enough to an institutional, you start to create a model on this platform.
Stuart, can I come to you? So again, where do you find that institutions are providing alpha for their investors when you talk to them on a regular basis?
Well, institutions have an easier job in some ways, in a simplistic sense, because they can pick and choose from multiple platforms to work with.
Yeah.
Plus, many of those platforms have different products. So the platforms are working to effectively create alpha in their product selection, their finance products they offer. And at the same time, the institutions can sit above it all and pick and move capital around to deploy it in the places they think they're going to get the best returns, best risk-adjusted returns. So I think that therein, of course, lies a risk, because the institution has the choice of all those platforms to work with and the products each of those platforms has. Whereas the platform has to set its stall out and pick its products, and it can't be as nimble, perhaps, to stay with where the alpha is.
How demanding do you find a lot of your institutional investors? I was asking this to Madelyn. I mean, do they come in and do they look at, you sit down with your credit underwriters and go through stuff? Do they look at all of your, do you look at sensitivity models to interest rates and different sectors? I imagine in the SME lending space have got different profiles. I mean, talk us through the level of detail that goes on when they come and talk to you.
It's very, very detailed. It's way more detailed than our retail lenders would go through.
Yeah.
Retail lenders focus on the micro side. They look at individual loans and credit reports and so on. Whereas institutions are looking at much broader subjects that the retail lenders just couldn't either get access to, wouldn't be given access to. But that's recursive, because then, of course, the institution coming into the platform gives them confidence, even though they haven't done that level of detail themselves. So the DD that's carried out is across the board. Now, I'm sure it'll come back in waves as we enter the next cycle. Shortly, possibly. I'm sure there'll be another wave of DD to retest books, to retest sensitivity analysis. We're just going through a big process now of stress testing the portfolio against 2 different recession scenarios, Armageddon plus the last recession.
And what were the results?
They're very good. We'll publish them shortly. But they would be, wouldn't they?
Yeah, I'm about to say.
We're a secured lender.
Slightly worries me with a stress test that actually doesn't have any stress.
Didn't hear about it otherwise.
I'm actually going to say to you, Chris, because you
stress test. Everyone's got a stress test.
Yeah, exactly.
It's like the buzz.
In property, exactly. In property, that stress.
Yeah. Well, I mean, we do 8-month loans, so the market's got to fall pretty heavily, pretty quickly to have issues there. But the property market is cyclical, so obviously
I was going to say
it will turn at some stage. I think certainly in London it already has. Certainly cooled off. So Yeah, so we do that sort of analysis as well.
And that's interesting. So do you find, and you do this to a limited degree as well, because you do property stuff as well sometimes, but in your property space, the property cycle moves in a slightly different cycle than the wider business and SME cycle. And a lot of people have been worrying for ages that the property cycle is near the top, certainly in the south. They've been worrying about that for a while. I did a big event with one of the big blue chip property companies, and they were basically counting down the weeks to when they thought the cycle was coming.
Yeah.
Do you find that people come in with a very different mindset than they do? Because basically, Madelyn, yours is SME funding. You're by and large SME funding as well. You do have small businesses, but you also are property related.
We are property related. So I think from an institutional perspective, where we get most traction quickest, sort of talking about realistic expectation of return and sort of an understanding of our credit underwriting and so forth, are with institutions that are experienced at investing in the mortgage market.
Yeah.
So understandably, when they come in, they know what they're looking for, and they can see the quality of the loans that we're originating quite quickly. So I think, for some institutions that are a bit more sort of asset agnostic, then they might have a bit more difficulty assessing exactly what we're doing. And I think people, it's a property-obsessed nation, so people do come with preconceived ideas of where they think the property market is in the cycle. I think, like I say, I think London's cooling off, but countrywide, I think the foundations are pretty sound. I think, the reality is we haven't been building enough houses, and we've got a population that's outgrowing the number of houses that are being built. So I think there's a strong foundation for the property market, and it's a very deep market for a platform to scale in.
You mentioned, it's a very, very interesting point, that you get a lot of people who are more conversant with investing in mortgages. That's the market they know. We know that's a big market. The residential mortgage-backed security market is big in Europe, and there are big players. But Simon, do you find that raises an interesting question? For instance, if I was to look in mortgage-backed securities, outfits like 24 and these guys spend a lot of time sitting around looking at commercial mortgage-backed securities, residential mortgage-backed securities, and they're big fixed income houses, and they're big fixed income credit houses, and there's quite a few of them out there actually, and even the big guys as well, quite very big credit departments who understand this space inside out. How can you provide expertise and the alpha against experienced, diversified credit players who've traditionally, those kind of guys, they've been playing ABS for years, they know ABS perfectly well, they know they know how to slice and dice stuff. How could you provide extra alpha? And I'll ask you as well, how do you provide extra alpha against those guys?
I guess there's 2 points to make there. Firstly, people like 24, etc., are originating products with a very long duration.
Yes.
So that's very different to what P2PGI does. Our average weighted duration is about 18 months, not 25 years. So we're selling or at least trying to sell a very different product with less interest rate risk than that. But look, I think actually with most peer-to-peer products, be it a small ticket consumer loan or a property-backed loan or an SME loan, the loans themselves have existed for hundreds of years.
Yeah, they're not there,
and therefore the expertise has been there. You can hire in the expertise. The thing that's changed is the origination mechanism, which is now lower cost. And that lower cost is hopefully shared between the borrower and the lender. So I'm less worried about being able to get hold of expertise, because I believe it's out there. You can hire it. What's more interesting to me is that these asset classes are now becoming available not via banks, and therefore offering our customers access to them for the first time.
I'll come back to that as the last point. Jean-Benoit, again, the reason I'm going to ask you particularly about this is because Eiffel is more a traditional credit shop. They are a credit. That's what they do. They do a lot of corporate credit. I mean, even though you guys come from Shepherd Capital background, and I suppose that you understand my question probably better, which is that surely I'd rather just go with the corporate credit guys who know what they're doing, and they're just coming to this space because this is another bit of the spectrum against specialist marketplace lenders.
Yes, but in fact, it's really different to manage a credit fund than a peer-to-peer fund. When you manage a peer-to-peer fund, you really have to work and to dig on the origination of the platform, and to know and to see if the platform has done a good job originating the good loan. I sit next to credit traders that have no idea how to value a loan on Funding Circle or on Rate Setter or on Lending Club. But what we do is we just take all the book that is originated since inception, and we just create default curve and analyze all the default of every loan and of every cohort. And in fact, you see quite rapidly if the platforms is able to, or is saying what it says, or it's doing what it says. If it just promises you 7% net interest rate, even if you have just 12 months of origination and 12 months of default, you can see if the default curve is going in the right sense or not. So it's a lot of analysis and of statistical analysis as well, and not really on looking at a specific company and digging in the number. The platforms does that. What we need to do is to be sure that the platform does a good job and to be able to see if the platform still is doing a good job through time.
I'll come back to you, Madelyn. On this one, both you raise a good point, which is traditional credit people are used to sort of getting stuff that's been sliced and diced and structured by banks. And there's a degree of provenance that comes with it, and then they can attach their metrics to it, and they have their ratings and loads of stuff that you can attach around the packet, and they have securitization, which we're going to talk a bit about later. When they come to platforms like you, relatively new asset class, they must be sort of sitting there going, well, what metrics am I going to use to structure this? What do I use? Do I just use risk grades, or do I use durations, or do you have ratings? Do you get what in a sense I'm asking? Because actually, oddly enough, Archie, of the three of you, property, they could sort of get their head around it. They sort of know their way around it. It's traditional SME term loans, again, they know their way around it. Yeah, it's not something they've massively invested, but yours is quite interesting and quite innovative space. What do you have to what do you have to get ready for them?
Yeah, well, I think first, a lot of the customers who come to us on the borrowing side, they weren't ever serviced by banks before. So even investors who have experience in receivables as distributed by banks, which there are not many of them.
Not many.
Still, it's we're serving a different subset of the SME space, much smaller SMEs.
Yeah.
I think first there's a lot of education on where exactly the risk lies. So many people assume that the end risk lies with the debtor, so the customer that's due to pay the invoice. That's not actually the case. The majority of the credit risk sits with the SME itself that's borrowing, that's financing and selling its invoice on the platform. So we do a lot of education to how our risk model works. The techniques we use are quite different. We'll look at basically the probability of insolvency of that SME during the life of the invoice. And because it's 40 days, we have to look at the probability of insolvency within 40 days. So our risk model is very sensitive to time, to duration. And then there are a lot of other variables, obviously, that we take into account. But there is a lot of education that we have to do with investors because for most of them, this is completely new.
And when you onboard them, on average, how long will it take from the point at which you first have a conversation to which they actually deploy some money? How long?
It really depends. Can be anywhere from 2 months to 8 months.
Okay, so quite a while.
Yeah, it depends how focused they are, how much work they have to do, if they're developing a new strategy on their side, if they're developing any kind of wrapper or structure that they need. So it really depends.
I just want to wrap up 2 questions for you guys. Look, we've already mentioned about the property cycle, which is its own cycle. Are institutional investors coming to you and being much pickier about what they're choosing now? Are they sort of going, I don't want London high-end premium, I want Leeds?
We've never actually been that keen on the London market.
Yeah,
so
I was about to say, I was probably
against a Mayfair house or something.
It's not your territory. But you get my point. Are they being much more specific about exactly what they want because where they are in the cycle?
I think they're probably being more specific about the return they want as opposed to the asset class they want. Which is fine, and I think that is, as a platform that sort of is scaling and expanding our product range, it's about finding a product that perhaps can work and meet their return expectations, but also mitigating the risk and creating that product so it's a sensible risk-adjusted return. Yeah, okay.
And Stuart, with you, again, the SME business cycle, which is slightly different than the property cycle, which is, and arguably has slight lag effects of the main overall business cycle. Where are we in the SME cycle at the moment? because we hear a lot. I mean, a lot of investment journalists like me spend my day pontificating about maybe we're closer to the end of the current growth cycle than we are to the beginning. In fact, I think it's an understatement of the century. And that actually defaults are picking up. And, you know, we've been hearing rumours of the industry that defaults are picking up. Where are we in the cycle at the moment?
Personal view, I think the next down cycle started Q4 last year.
Really?
But I think it's going to be a soft one this time. And then we're off again for another 7 to 10 years from where we stand today.
So what do you mean by soft?
Softer fallback. Defaults will go up. Property prices won't wobble too much. There's going to be there's a very complicated situation, isn't there, going on economically, globally at the moment. And I think it's hard to tell for sure, but I'm definitely seeing signs of things slowing down, driven by caution. So it'll come from where the money is, so institutions will drive some of that caution, businesses will see uncertainty, Brexit, etc., and begin to apply caution. So there's multiple small braking effects happening across the economy, and it's whether after June and after other events people get confident again. But I think we're slowing down a bit, and we've been talking about the R word for some time, just to be sure we're ready for it.
Samir talked a bit about they do their own modelling at Funding Circle, where they think up to 2 times that defaults, or and he, I think quite rightly pointed out, you could do up to 5 times defaults and you still get a net return. Where do you think the quantum of increase is, if it's coming?
Yeah, certainly a 5 times multiple is very, very possible in SME space. I mean, we're unsecured, so it's different. We have expected loss rates of fractions of a percent in most normal situations on an annualised basis. But of course you've got the history, so you've got the snap effect, haven't you, with secured lending, where if your book is on say a 65% LTV, and you have Armageddon, you'll go through that point and then your losses will accelerate dramatically. In unsecured space, it's a more of a linear effect. So, yeah, you're going to see consumer lending default rates going from 1% currently up to about 5%.
Very quickly, Madelyn, are you seeing it in any of the MarketInvoice book? Are you seeing the default, the R's and D's, recession and default, are they slowly beginning to pick up?
Not really. I mean, we have an element of seasonality through the year, but as it's short duration, we can adjust pretty quickly, and we haven't seen anything too drastic.
Okay, cool, lovely. Okay, excellent.